Cleveland Fed President Loretta Mester expecting rate cuts at some point this year, but couching the timing just a bit, saying, quote, "We will start to normalize policy back to a less restrictive stance, but we don't have to do that in a hurry." So let's talk about what we could expect going forward. For that, we want to bring in Dave Mazza, joining us here at the desk, Roundhill Chief Executive Officer. Dave, it's great to have you here. So where do you stand? We've been talking all morning about where everyone else stands on rate cuts. What's your base case, and how important do you think it is to the market's momentum?
Yeah, and the second part of your question is really interesting here. So we saw the Powell pivot last year has become the Powell divot because we cannot get out of this Scrooge of inflation, particularly when we think about sticky prices versus flexible prices. And so the Cleveland Fed has great measures where they categorize inflation categories into those areas to say, hey, what actually historically has a lot of volatility and what doesn't? The problem is the sticky prices aren't supposed to be this high. And so that makes a very difficult job for the Fed. When we think about going forward, obviously June is well off the table. July, maybe, but I think that's unlikely. And it's been pushed out. The challenge is we know the Federal Reserve doesn't want to be seen as influencing the election. And that's coming in November. So maybe we could get that September cut. But at the end of the day, it's all going to depend on where inflation lands. And right now, that picture does not look very positive.
And so with that in mind, I mean, a lot of people are trying to figure out what that means for their portfolio strategy now if you're pushing out the pacing of those cuts and even looking into, we had a guest already say we might not even see it until late 2025. So what does that mean for the portfolio strategy in the interim here?
So our base case is that we do actually get some cuts this year, probably one in September. That's an interesting argument to be made because if about that 2025, because if inflation does stay high, it's going to be hard for them to do that. However, it is clear that only recently has the market picked up on the fact that the equity market, I should say, picked up that rate cuts may not happen. But what's interesting this time around is that unlike the hope for cuts that we saw during the COVID period, the economy is actually much stronger. And that's also confounding to investors and really actually confusing for economists because everyone was expecting that we would see a material slowdown, particularly in jobs growth. It hasn't happened yet. So now there's not necessarily a reason for the Federal Reserve to move as soon as many had expected.
So, Dave, then when it comes to the market's momentum, the pressure is really on earnings, right, to live up to expectations, given where valuations are. Yes, we have fallen in the last couple of days, but overall sentiment, clearly, we're not too far from those all-time highs. Do you expect earnings to live up to those expectations? And then further than that, if we do see any sort of disappointment, particularly from the Mag 7, how worrisome is that going to be?
Yeah, it's really interesting. So markets are, S&P is off 4% of its all-time high, but people are freaking out for good reason because it's been really a steady path forward in 2023 and unexpectedly in 2024. But this earnings season, it's cliche to say that every earnings season is important. This is the show me the money earnings season because valuations have increased so much across the market. And if earnings don't come to the extent that people are looking for, particularly from the Magnificent Seven, which has lifted earnings for the broader market, it's difficult to see actually the ability for markets to continue to go higher. But if they beat, particularly out of these big companies, Netflix, not a Magnificent Seven name, but certainly going to be important at least for sentiment, particularly with Tesla reporting next week, then I actually think we can see markets regain their footing even, and actually propel higher, even with some of the negative macro headlines.
You know, we love a good Jerry Maguire reference to start off the day here, so I appreciate that from you, Dave. When we talk about this earnings season and the tenor we're expecting to hear from many of these CEOs, it also comes back to a demand story and where they're seeing resiliency among their consumer, and that consumer can be larger businesses on the kind of B2B side, or it could be B2C on the business to consumer side. What are you expecting to hear on demand specifically?
Yeah, it's interesting. So we started to hear some whispers of negativity from the consumer that came in the last earnings season. Didn't necessarily impact the broader market, but looking right now, particularly with the Magnificent Seven, they've been an opportunity for offense for investors because of their AI exposure and defense because of their strong balance sheet and resilient earnings. But really what I'm going to be looking for across the market, not just with the Magnificent Seven names, is what impact is inflation having on demand, to your point, and particularly profit margins, because they have been exceptionally strong for those mega cap tech names, but particularly less so for other areas of the market. And if we actually see pressure there and deceleration of margins, that actually is likely going to be a bigger negative.
Dave, what do you think is the biggest worrisome challenge, potential headwind here for the markets? Because we talk about so much that outside of everything that's happening with the Fed. But when it comes to the fundamentals of the market, we talk about that there's still a lot to be excited about. Are there any areas of weakness or something that you have your eye on that maybe the broader investment community isn't really talking about yet?
Well, I continue to be concerned about small caps and non-profitable companies, right? A lot of folks expected that there would be a rotation, and that's very logical, especially when you're expecting rate cuts. But we haven't seen that. And so non-profitable companies, the Goldman Sachs index of non-profitable companies is down 23% year to date. And these are companies that are going to continue to struggle in a higher interest rate environment because their funding costs are much higher than many would have anticipated. And so if we continue to see the divergence where mega cap continues to lead because of strong earnings and smaller cap, more cyclical names do poor, then I actually think we can get in an environment where we do truly get ahead of ourselves and we don't necessarily see a breather. So I'm actually keeping stocks on a much shorter leash than I had before because of these headwinds, even though I'm generally still positive.